Welcome to Capital Insights. Thanks so much for taking the time to be with us today. I think we all know at this point that for safe investors, we've been living through a relatively rough period over the last 7 years or so. And these are investors who traditionally might have invested in bank CDs, US Treasury bonds, etc. And we all know what's happened. The Federal Reserve has kept interest rates very, very low. What started as an emergency measure back in late 2008 and early 2009 has kind of turned into commonplace policy, 7 years later. And what that has really done is it's stripped safe income from the economy. For safe investors who really don't want to take a risk, this has been a problem. And for retirees, this has absolutely been a problem also. What we've also seen in the current cycle, and it's partially related to this, is that personal consumption has been very, very low. Well, when you take a major piece of income away from an economy, that's what happens. And we get things like a major retailer like Macy's closing 110 stores to come in the United States. We wonder why, right? Not too much of a mystery. We all know this. This is headline news. We've been living with it now for the last 6 or 7 years. Nothing new here. But behind the scenes, are there other issues related to Fed interest rate policy that we need to think about as we move forward? And the answer is yes. One of the things about risk management in investing and trying to look ahead is anticipating what is going to be an issue for tomorrow, not for today. The markets always look ahead. They don't look behind. So in one sense, maybe analogously, we look for news on, let's say, page 15 in the paper, if anybody still reads papers. Issues that on page 15 are going to move to page 1 in the next year or the next 2 years. Well, one of those issues, and it very much relates to interest rates, is what's happening to pension funds in the United States. We know that a lot of pension funds are what are called underfunded at the current time. Underfunded meaning if they shut down their operations today, they couldn't pay out all their obligations. They need to either have more contributions to that fund or they need to earn more money over time. Well, this isn't a new problem. This is a problem that's been going on for a long time now. Pension funds have very long-term obligations. We know that. They're not going to come crashing down tomorrow morning. We've got another 10, 20 years of baby boomer payouts over time to come. So we've kicked the can down the road for many years. And it's a tough issue because politically, we have to take, if you will, spending from another part of the economy and fund a pension. Well, how, if you will, wonderful is that for a political message? And the answer is it's not too good. So what we're seeing at the current time is there's a lot of public, and this is really where the locus of the issue is, not necessarily in the corporate sector. If corporations have a pension shortfall, they're going to make it up out of their profits. But public pension funds make it up out of increased taxes. And that's one of the issues. So let's use an example. And again, remember, this is not about melodrama, and the world is not about to come to an end tomorrow. But this is news that's on page 14 or 15 that we think has a very good chance of moving to page 1 in the next market downturn. The second largest public pension fund in the United States just happens to be right in our own home state, CalPERS, the California Public Employees Retirement System. CalSTRS, the state teachers retirement system, isn't too far away in terms of total value. CalPERS is a fund that has about $300 billion at the current time. And one of the keys in pension fund accounting is looking at what's called the actuarial rate of return assumption. What does that mean in English? Well, in English, what that means is if a pension fund earns its assumed rate of return every year, everything will be fine. All the numbers will work out. They'll pay the last nickel out to the last retiree about 5 seconds before they pass away. That's what they'd love to do mathematically. There's never that much mathematical certainty, but that number is an important number. And for CalPERS, that number is 7.5%. So academically, if they earn 7.5% every year, not a problem. Everything will be fine. In the 12 months ended June 30 of this year, they earned 0.6%. A year ago, they earned 2.4%. Is the world again about to come to an end because CalPERS didn't make their rate of return assumptions in the last 2 years? No. They've done well over what has been a 35-year greatest bull market in bonds that we've ever seen in our entire country. And also, prior period returns, they've lived through the second longest bull market for stocks in US history, which is continuing to play out as we speak. So they're not at a crisis stage yet, but what is an issue for them now, and over these years they've been able to invest in stocks and bonds, as well as real estate, private equity investments, etc. But the key issue is that rate of return on bonds has gone away. And this has been one of their keys over the last X years. If we look at every dollar that CalPERS pays out right now, 15 cents of that dollar is an employee contribution, 21 cents of that dollar is an employer contribution, in other words, taxpayer money, and 64 cents on the dollar is investment return. Well, at the current time, you can earn a rate of return on a 10-year US Treasury that's 1.65% for the next 10 years. But CalPERS needs 7.5%. So that means they need an offsetting investment that's going to guarantee them close to 13 or 14%. Where in today's world are we going to find this? The answer is virtually nowhere. So, what the Fed has done by lowering rates to try to support the economy, to try to support individual households, and really, we need to remember, the Fed is not a public institution. The Fed is privately owned by the banking system, and its charge, first and foremost, is banking system solvency. It's not where they set interest rates. So what the Fed has done with setting rates so low is it's also taken away rate of return from the pension fund community that's already facing underfunded pension funds at the current time. And this is happening at the exact time that baby boomers are accelerating into retirement years, and the drawdown needs, the payment needs from these pension funds is accelerating, and it's accelerating fast. So where do we go from here? What does this mean to us as investors? What does this mean to the markets? Well, first, and the Fed is not ignorant of this by any means, they know they're going to need to normalize interest rates. Is the Fed the cause of the pension issues at the moment? No. They're a part of the cause, but the major part of the cause is political indecision over the last X decades. But here we are. So as we move forward, we know the Fed is going to need to normalize rates, and it's going to need to happen relatively soon. Maybe not tomorrow, but certainly that process has to begin in earnest over the next few years. Secondly, we need to watch it on taxes, and we would suggest to you that one of the poster children of the moment is the state of Illinois, and specifically the city of Chicago. Chicago's underfunded pensions have been known for many, many years now. This is nothing new by any means. One of the largest state teachers' retirement systems happens to be in Illinois, and that fund is underfunded very, very meaningfully. So what's happening right now in Illinois? Well, income taxes are going up, property taxes are going up, and there's no two ways around this. The taxpayers are going to have to fund these pension shortfalls if they can't be funded by any other means. Illinois is just one of the first pension funds that has arrived at, if you will, the pension fund crisis party. It's the very beginning. It's not the end. And as we look forward ahead, this, we believe, will be an issue that moves toward the front page as we get into the next market downturn. We're not hoping for a market downturn by any means, but it's the normal cycle of markets. This is how they play out over time. So we just need to be aware of this. We need to be aware that this is a meaningful issue. It could impact us in that higher taxation at the household level, both property taxes and income taxes, are going to put a dent in personal consumer spending in the years ahead while we try to reconcile these issues that are playing out before us now. Remember, and it may be a horrible, horrible analogy, but we're always looking ahead, we're always looking forward in the dark to try to avoid hitting icebergs that are only lit up by moonlight at the current time. So we hope this gives you a little sense for not only one of the key issues that's come ahead, but our thinking in terms of anticipation and how we ultimately bring that into risk management in the investment management process itself. Again, very much appreciate your time in being with us. On behalf of the entire team at Capital Planning Advisors, thank you so much. We'll see you very soon.